Welcome to our comprehensive guide on unlocking shareholder value through smart dividend analysis. In the dynamic world of business and finance, understanding how to evaluate a company's dividend policy is paramount for investors aiming for both income generation and capital appreciation. This session will demystify the core metrics that savvy investors use to assess a company's financial health and its commitment to returning value to shareholders. We'll delve into dividend yield, payout ratio, and dividend growth, three critical components that, when analyzed together, paint a clear picture of an investment's potential. By the end of this presentation, you'll be equipped with the knowledge to make more informed investment decisions, identify sustainable income streams, and build a resilient portfolio. Before we dive into the analytical metrics, let's establish a foundational understanding of what dividends truly represent. Dividends are essentially a portion of a company's earnings that it chooses to distribute to its shareholders. Think of it as a reward for your ownership, a tangible return on your investment in the company's success. This distribution can take various forms, most commonly cash payments, but also stock dividends or even property dividends in rare cases. Companies typically pay dividends on a regular schedule, such as quarterly or annually, reflecting their profitability and confidence in future earnings. For many investors, especially those focused on income, dividends form a crucial part of their total investment return, providing a predictable cash flow stream. Dividend yield is perhaps the most straightforward metric for income investors, representing the immediate return on investment from dividends alone. It's calculated by dividing the annual dividends per share by the current stock price. For instance, if a company pays $2 per share annually and its stock trades at $50, the dividend yield is 4%. This metric is crucial because it helps you compare the income-generating potential of different stocks. However, interpreting it requires nuance. A very high yield might signal underlying problems, such as a recent drastic stock price drop, while very low yields might indicate a growth-focused company that reinvests most earnings. Stable, mature companies often target yields between 2% and 5%, balancing investor income with reinvestment needs. Moving beyond just the yield, the payout ratio is a critical indicator of a company's ability to sustain its dividend payments over the long term. It tells us what percentage of a company's net income is being paid out as dividends. The calculation is simple: total dividends paid divided by net income. For example, if a company has a net income of $100 million and pays out $60 million in dividends,